Welcome to Breaking News to Trading Moves.
So today we're looking at something pretty specific, a really clear reaction in the market.
Yeah, we're going to trace the capital flows following that recent update from Oracle, that's ticker ORCL.
Exactly. And you saw a very distinct change in what investors wanted to own. Our job here is to figure out why.
Right. We want to isolate the exact facts in that Oracle announcement that got the ball rolling, and then, map out which sectors and companies benefited and which ones took the hit.
It's all about a specific rotation of capital. It wasn't just general market fear. This was driven by new information about business operations.
The headline event was really that forecast from Oracle. It seemed to pour a little cold water on the whole AI theme, didn't it?
It did. It raised some very valid concerns about the cost structure, the viability of it all.
And when a dominant theme like AI gets questioned, not about its long-term potential, but about its immediate path to making money.
Money moves fast. And that's what we're going to follow for you, the mechanics of that movement.
So the forecast from Oracle, it basically put a much higher, much more immediate price tag on the AI build-out than I think a lot of people had modeled.
And that forced a recalibration. The mood music changed from just pure growth enthusiasm to a much sharper focus on spending, on cost control.
Okay, let's start right at the beginning. The Oracle report itself, ORCL. You said there are two components here that really mattered.
That's right. It was the combination that did it. One piece of bad news on its own probably wouldn't have caused just this broad of a reaction.
So what was the first piece? The core financial miss?
The first part was pretty standard, really. It was backward-looking. Oracle's quarterly results, they just came in below what Wall Street analysts were expecting. Revenue, earnings, both a bit light.
Which for a big, mature company like Oracle is never great, but that usually just hurts their own stock, right? A company-specific problem.
Usually, yes. But it wasn't just about the past. The market is always looking forward. And that's where the second piece comes in.
The guidance.
The company's forecast for the immediate future. That also came in below what the street wanted to see.
So 2 data points right there. The last quarter was weak, and the next few quarters are looking weaker than expected.
Exactly. It suggests that whatever growth they were hoping for wasn't, showing up as quickly as the market had priced in.
That's a bad setup on its own. But the part that made this a market event, the thing that kicked off this whole rotation, was about spending, the capital expenditure.
This is a real pivot point. ORCL didn't just miss their numbers. They also said they were going to have to spend a lot more money to keep up.
And specifically on AI.
Specifically on AI-related
CapEx, capital expenditures. This is the heavy lifting. Building data centers, buying tons of expensive, specialized hardware like GPUs. It's a huge bill.
Okay, so let's piece this together. The combination effect. We have a weaker financial outlook list of money coming in the door near term.
Right.
And at the same time, a much bigger bill for investments. A lot more money going out the door. And it's all tied to the AI story that's been driving the market.
And that combination is what triggered the alarm bells.
Why? I mean, why would that specific pairing cause such a big exit from the whole sector?
Because it hits at the very core of the investment thesis. Those two facts colliding, lower results now, higher costs coming, it revives these fundamental doubts about the payback, about the profitability timeline for all this AI spending.
So before this report, investors were thinking, great, spend as much as you want on capex because the AI revenue is coming and it's going to be huge.
And imminent. They thought it was right around the corner.
Yeah.
The Oracle report challenged that imminence. The question suddenly became much more practical.
It's not, is AI the future anymore?
No, it's, will the companies building the future actually make enough money from it and soon enough to justify these massive valuations?
That's a key distinction. So the market went from cheering on AI spending as a sign of growth to scrutinizing it as a drag on profit.
You hit the nail on the head. The question became, what's the concrete return on this investment and how long do we have to wait?
And that uncertainty just reduces the overall appetite for risk, especially in tech, where valuations are already stretched.
It does. It suggests this whole AI build-out might be a longer, more expensive arms race than people thought. And when that happens, capital looks for safety, for stability.
So the market's message is, if you're spending this much, you better show me the money is coming soon. Otherwise, we assume the costs are just running away from the profits.
That's the sentiment that drove the rotation.
Investors decided the cost-benefit analysis was just too uncertain for these high-priced tech stocks, so they fled to assets with more predictable cash flow.
Okay, so when investors get hit with
Data like that, they don't just sell and go to cash, not the big funds anyway. They reallocate, they de-risk.
Right, the money has to go somewhere. And it flowed into places that offered a refuge from the specific uncertainty that Oracle's report brought up.
Let's trace this out. There were three distinct categories where money reportedly went to.
It went to areas where the business model either benefits from market churn or is completely separate from this whole AI infrastructure spending question.
Let's start with the first one, which seems a bit counterintuitive. Companies that actually do well when the market gets nervous. Volatility and trading venues.
Yeah, the principle here is that uncertainty drives transactions. When a big, concentrated theme like AI gets questioned and those stocks start moving around a lot,
Volatility goes up.
volatility goes up. You see it in metrics like the VIX. And when that happens, trading volumes increase.
And hedging activity really takes off.
So a fund holding billions in, say, Microsoft, MSFT, or NVIDIA, NVDA, they get worried.
They can't just dump all their shares at once. So what do?
They hedge, they buy put options to protect the downside, they use futures contracts, and all of that activity, all of those extra trades flow through the exchanges.
Plus, everyone is scrambling for real-time data to figure out what their tech stocks are actually worth now.
Exactly. And the exchanges, their business model is built on taking a tiny slice of every transaction. So more trades, more options, more data requests, that's all just more revenue for them.
And their business doesn't really care if the stocks are going up or down. They just profit from the activity itself.
They're insulated from that whole AI capex cost issue. Their profitability is driven by the movement.
Okay, so which companies specifically got a lift from this?
Well, we saw CBOE Global Markets, that's ticker CBOE.
CBOE get a mention. Also Intercontinental Exchange, ICE, and NASDAQ, NDAQ.
And CBOE is big in options, right? So that makes sense with the hedging.
A huge player, a direct beneficiary of that increase in hedging volume. And ICE and NASDAQ, they operate the major exchanges and provide that critical market data. When capital is reallocating this quickly, their volumes just spike.
Okay, that makes sense. Now, what about the second category?
This is the classic move, the place of defensives. This is the trade you always see when the main engine of the market, which right now is tech, starts to sputter.
So what's the principle here? Why dump a tech company that could grow exponentially for, a consumer staples company that grows a few percent a year?
It's about choosing reliability over uncertain growth. The concerns that Oracle raised pushed investors toward assets with stability, dependable income, and just less drama in their earnings. The key is demonstrable cash flow.
Let's talk about this parking spot concept. What does that mean for someone managing a portfolio?
It means
You're looking to preserve your capital. A huge fund can't just sit in cash. They have to stay invested. But they need protection from the uncertainty that just popped up in tech.
And these
Defensive sectors like consumer staples and healthcare, they offer that protection.
you do. They have steady earnings and, maybe more importantly, reliable dividends. That dividend acts like a cushion, a floor under the stock price.
So an investor sells an AI stock valued at, say, 50 times earnings of price based on a future that's now in doubt. And they move that money into a staples company at maybe 20 times earnings, and they get a 2 or 3% dividend yield while they wait for the dust to settle in tech.
That's the trade, in a nutshell. You're trading that potential massive upside for immediate proven income. It's a parking spot. People are still going to buy toothpaste and soda, regardless of Oracle's capex plans.
So who are the classic examples here that saw inflows?
The names mentioned were Procter & Gamble, ticker PG, the Coca-Cola Company, KO, and Johnson &
Johnson, J&J.
PG with consumer goods, KO with beverages, J&J in healthcare, all businesses with very predictable earnings.
Completely predictable. The polar
opposite of the speculative high-cost nature of the AI build-out.
Okay, so that brings us to the third group of winners, financials. Now this one's a little different. They're cyclical, tied to the economy. If the market is worried, why run to the banks?
That's a really good question and an important clarification. This isn't necessarily a bet on the economy suddenly getting stronger. It's more a move based on scale and liquidity.
Meaning they're just big companies that are easy to trade.
Pretty much. When you're trying to move billions of dollars out of mega-cap tech stocks, you need to put it somewhere else that can handle that kind of volume. Large financials offer that liquidity.
So they're just another big liquid bucket to put money in that isn't tech.
Exactly. They're an alternative. And their risks are different, They're tied to things like interest rates and the broader economy, not the specific operational headache of an AI build-out that Oracle highlighted.
Got it. So which institutions benefited in this environment?
The materials pointed to JP Morgan Chase & Co., JPM, and Goldman Sachs Group, GSES.
JP Morgan is kind of a bellwether for the whole system. And Goldman Sachs?
Goldman, GS, can actually benefit from this kind of environment. All this transactional activity, this portfolio shuffling that generates fees for an investment bank. When money is moving, they do well.
And there was a note that strength in Goldman actually helped support the Dow Jones on one of these days.
There was. Which just confirms their role as a sort of anchor when tech leadership is faltering. Capital is looking for stability, proven business models, and liquidity. The big banks provide all three.
That lays it out perfectly. Money leaves the high-priced, uncertain growth story and moves into places with stability, fees from volatility, or just proven lower-priced cash flows. A very tactical, risk-off move.
Now we have to look at the flip side of this, which I think is even more telling about the market's specific fears.
The losers.
The losers. After that Oracle news, the market's whole valuation model sort of changed overnight. It started demanding proof of profit, not just promises. And we saw three main groups get hit with selling pressure.
It seems like the market just took the risk that Oracle flagged and applied it to every company that looked even remotely similar.
That's precisely what happened. The focus shifted from celebrating how big the spending was to asking how long it would take for that spending to pay off, and that put the biggest spenders right in the crosshairs.
So category 1, the AI capex heavyweights, the big cloud and data center players.
But if Oracle, ORCL, is flagging rising costs, why does that punish Microsoft, MSFT, and Amazon, AMZN? I mean, they have much deeper pockets.
They do, but they're all playing the same game. They operate these massive competing cloud platforms, Azure for Microsoft, AWS for Amazon. The market assumes that the cost pressures hitting Oracle are hitting them too.
So the thinking is, if it costs Oracle more to compete, it must be costing Microsoft and Amazon more as well, and that's going to squeeze their margins.
You got it.
It raises a really fundamental question. Is this an arms race where the competition is driving down the price of AI services faster than they can sign up new customers? The cost of the race is going up,
But the prize at the finish line might be less profitable than we thought.
It all comes back to that payback timeline risk.
Yes, investors are now looking much more closely at how quickly these giants can turn these billions in capex into high-margin revenue. The companies named here were Oracle itself, of course, ORCL, along with Microsoft, MSFT, and Amazon, AMZN. They carry the biggest burden of this build-out, so they took the most direct hit.
Okay, now, for what's often the most sensitive part of this whole theme, the hardware suppliers, the AI semiconductors, and the server supply chain.
Ah, yes. The high beta group. When the core AI story gets a reality check, these are the names that tend to fall first and furthest.
Explain that sensitivity. Why are they considered high beta?
It's because they have leveraged exposure to the whole AI sentiment. Think of them as the picks and shovels in this gold rush. Their future sales depend
entirely on the assumption that the big cloud companies will keep spending more and faster and faster.
So they're a leveraged play on the theme. A chip company might be valued even more richly than a
Cloud company, because their growth is supposed to be even faster.
Exactly. So when the Oracle report questions that spending timeline, the whole assumption of accelerating future orders gets challenged. Any little hiccup in future spending plans gets magnified in their earnings models.
Even if the long-term trend is still positive, just a hint of a slowdown or a delay can trigger a huge reaction in the stock.
That's right. It leads to what's called multiple compression.
Let's break that down. If a stock like NVIDIA is trading at 50 times its future earnings because everyone believes those earnings will grow 100%,
Right.
and this new information suggests that growth might only be 70 or 80%, then the market instantly decides that 50 times is too expensive.
And that multiple gets compressed down to a lower level, maybe 40 times. And that adjustment, that re-rating, causes a really sharp drop in the stock price. It's just swift risk-off selling.
So who got hit in this high beta group?
The list included NVIDIA, NVDA, Advanced Micro Devices, AMD, Broadcom, AVGO, and Supermicro Computer, SMCI. These are the engines of the
Build out. NVIDIA in particular has just been riding this narrative of endless cloud capex.
And we saw reports of broad weakness across the whole chip sector.
We did, which confirms this wasn't just one or two names. It was a systemic reaction to what Oracle's costs implied for the entire hardware supply chain.
Okay, so that brings us to the final category of losers. This group is less about the physical hardware and more about the specialized software companies.
Yes, entirely different kind of risk, which you could call narrative risk.
Narrative risk, meaning their valuations are based more on a great story than on current profits.
In a way, yes. Their high stock prices are often based heavily on the AI growth narrative, the story of future dominance and massive adoption, not necessarily on huge current cash flows. They are priced for a perfect, frictionless AI future.
So if the market starts to
Question the efficiency of the underlying spending that's supposed to fuel their growth, the whole story starts to look a little shaky.
Exactly. If people start worrying that AI is just becoming too expensive
To
to
deploy, it raises questions about how fast companies will actually sign up and pay premium prices for this specialized software. The high multiples on these stocks just provide no cushion against that kind of doubt.
I see the difference. For Microsoft, MSFT, the risk is their cloud margins get squeezed. For a company like Palantir, PLTR, the risk is that the big payday everyone is expecting gets pushed way out into the future.
That's a critical distinction, and that forces investors to pivot. They start demanding companies that can prove it now, with real earnings and cash flow, that defensive trade we talked about, instead of sticking with companies that are just selling a story about the future.
So which of these high multiple software companies were mentioned?
Palantir Technologies, ticker PLTR, was on the list. Also Snowflake, SNOW, and MongoDB, MDB. These are all names that are very sensitive to any skepticism about the immediate
profitable rollout of AI. When the market demands proof, the companies most reliant on promise are the first to get sold.
This really has been a clear-cut case of capital rotation
Based on some very specific operational news. So to synthesize this for you, the listener, the Oracle report, ORCL, created doubt about the immediate profitability and rising costs of the AI build-out.
and that led to a very clear movement of capital. On the winning side, you saw a defensive move into stable, cash flow positive sectors, companies like Johnson & Johnson, J&J, Coca-Cola, KO, and Procter & Gamble PG.
We also saw money flow into big liquid financials like JP Morgan, JPM, and Goldman Sachs, GS, and into the exchanges themselves like CBOE and NDAQ, which benefit from the volatility.
And on the other side, the selling was really focused. It hit the tech sectors most exposed to AI spending costs, the cloud giants like Microsoft, MSFT, and Amazon, AMZN.
The high-flying chip makers like NVIDIA, NVDA, and AMD who face that multiple compression risk.
And then the richly valued software names like Palantir, PLTR, and Snowflake, SNOW, who are so reliant on the AI narrative.
The core conflict here is really about cost versus payback.
And now that the market has shown how sensitive it is to these spending costs, it raises a final question for you to think about. If the AI race is more expensive and the payoff is further away than we thought, what happens next? Do companies pull back on their spending, or does this just test the patience of truly long-term investors?
That is definitely a complex